Let's step back and look at the stock market as a machine, a system that's been running for centuries, driven by a few simple principles. I want to take you on a journey to understand how it started, how it works today, and the timeless truths that keep it going. Think of this as a big economic machine with lots of moving parts. People, companies, money, and confidence, all working together in a cycle. When you see how the pieces fit, you'll get why the market behaves the way it does. Imagine it's the 1600s. The Dutch East India Company is a massive trading operation, hundreds of ships sailing across the world, bringing back treasures like spices, gold, and silks. These voyages are incredibly profitable, but they're also expensive. Ships need supplies, crews need wages, and goods need to be bought up front. The company can't fund everything on its own, so they come up with a clever idea, a way to share the risk and the reward. They go to ordinary people, merchants, craftsmen, anyone with a bit of extra money, and say, invest in our next voyage. Give us money now, and when the ship returns loaded with riches, you'll get a share of the profits. It's a deal that makes sense. The company gets the cash to send bigger, better ships, and the investors get a chance to grow their money. This is the first principle at play: shared risk, shared reward. It's the foundation of what we now call the stock market. These deals start happening in coffee houses and shipping ports across Europe. They call the investments shares. You're buying a piece of the voyage. Without even realizing it, they've created the world's first stock market. It's a system where people can pool their money to fund a business and share in its success. This idea is so powerful that it changes the world, and it's still the core of how the market works today. Fast forward to now, and that simple idea has evolved into a global system. Let's break it down with an example to see the machine in motion. Imagine a new company called Bean Buzz. They want to sell amazing coffee everywhere, but they need money to get started. Buy beans, build shops, hire baristas. They don't have enough cash on their own, so they turn to the stock market to raise it. First, they go to big investors, the ones with deep pockets, and pitch their idea. We've got a great plan for Bean Buzz. Invest in us, and you'll own a piece of the company. If the investors like the idea, they put in money. This helps Bean Buzz launch an IPO, an initial public offering. Think of an IPO as the company opening its doors to the public for the first time. Now anyone, you, me, or any investor, can buy a stock, which is just a tiny piece of Bean Buzz. When you buy a stock, you're part owner, and your money helps the company grow. Here's the second principle. Stocks are a way to align interests. Bean Buzz gets the cash it needs to expand. Maybe they open new shops or create a new latte. As an investor, you're betting on their success. If they do well, more people want to buy their coffee and their stock. When more people want a stock, its price goes up because demand pushes the value higher. That's good for you. Your little piece of Bean Buzz is now worth more. For the company, a higher stock price means they can raise even more money to grow because people see them as valuable. It's a cycle of confidence and growth. But here's where the machine gets tricky. The stock market isn't a straight line. It's a cycle of ups and downs, driven by cause and effect. Let's say Bean Buzz hits a problem. The price of coffee beans spikes, or a rumor spreads that their coffee isn't great. Investors start to worry. They think, this might not work. I should sell my stock before it's too late. When lots of people sell, the stock price falls because there's less demand. Suddenly, Bean Buzz's value drops, and if you're still holding that stock, you might lose money. Why does this happen? It's all about confidence, the third principle. The stock market runs on belief. When people believe in a company, they invest, and the price goes up. But when they lose faith, they sell, and the price falls. This confidence can be shaken by all sorts of things: rising costs, bad news, new competitors, or even bigger forces like economic changes or new regulations. Sometimes people sell for reasons that have nothing to do with the company, like needing cash for a vacation. All these factors make the market move every day, sometimes wildly. This up and down cycle has big consequences. When confidence is high, the market can grow fast. Think of the economic booms we've seen in history. But when confidence collapses, crashes happen, and value disappears quickly. That's why the market can feel like a roller coaster. One day, Beanbuzz is a star. The next, it's struggling. Perception matters as much as reality. If people think a company is failing, they stop investing, and that can make the failure real. Here's the fourth principle. The stock market rewards patience, not chasing quick wins. Smart investors know this. They don't try to guess the daily ups and downs. That's too risky, because the market is unpredictable in the short term. Instead, they focus on the long game. They invest in solid companies with good ideas, like a Beanbuzz that's solving real problems, and they wait. Over time, the cycles even out, and good companies grow, even if they hit bumps along the way. Let's zoom out to the big picture. Back in the 1600s, only the rich and powerful could invest in those Dutch ships. But today, the machine is open to everyone. Thanks to technology, you can buy stocks right from your phone. You don't need to be a millionaire. You can start small, pick companies you believe in, and grow your money over time. More people are learning how the system works, and they're joining in. It's a chance to be part of something bigger, supporting ideas you care about while building your own wealth. The stock market isn't magic. It's a machine with clear rules. It started with a simple idea in the 1600s. Share the risk, share the reward. Today, it's grown into a global system, but the principles haven't changed. It's about aligning interests, building confidence, and playing the long game. Yes, it's wilder and more complex now, with new tools and tricks to navigate it. But at its core, it's still about people coming together to fund ideas and grow together. So what do you think? Are you ready to step into this machine? It all starts with understanding how it works and finding your place in it. Let me know your thoughts.